Please let me know if you can see my slide real quick, guys. Okay, you can see my slide. Yes, I can. I believe yes, I can is a response to the question, can you see my slide? All right, so without wasting any time, because I want us to finish up, go as far as we can today. So yesterday we introduced everyone to what we do, okay? And I told you that as a trader, if you want to be accurate about your decision, whether to buy a currency pair or to sell a currency pair, you have to rely on the economy of the country. All right. So if you think America is a strong country, America is going to improve, you buy dollar, right? Okay, hoping that it's going to rise over time. But if a country is going down the drain, they have crises, you know that it's going to show up in their currency. And then that is the way traders were trading currencies in the past. Okay, so they look at the economic data and then they use that information to make trading decisions. All right, so but the problem we had with that was that it wasn't enough for traders to make buy and sell decision on a day-to-day basis. All right, so if I want to trade today and I want to buy pounds against dollar, you know, or euro against pounds, I need something else to make that decision so that I can buy it today and close it today. And that thing is just something that we say that, okay, this is based on history, based on what has been happening over the years. We can say that whenever the price comes to this level, it will rise. Whenever it comes to this level, it will rise. So traders now say, okay, the price has now gotten to this level. It's about to rise. Let's buy. All right. There is no guarantee that this time around, when it comes to that level, it will rise. That's TA. That's what we're doing. Okay. So everything you're going to be doing, I showed you one of the slides and I told you that, yes, this slide I am showing to you. I am showing you because, yeah, I told you I was showing you the slide because, excuse me, I have to be sure. Please, let me know if you can see my slide. I'm not getting my buttons correctly here, and that only happens if I am not sharing correctly. So that's technical analysis, guys. So I introduced you to technical analysis, and I told you that in TA is just adding weights to the coin so that it will come up in our favor. All right, and then there was a slide I showed you where I told you the path to becoming. I showed you where to begin from, where we now say, okay, let's have a Luno wallet. All right, how many of you got that Luno wallet? Yeah, you missed them all. You can get them. I think some of them are even on YouTube already. So you make a request for it. Yeah. Okay. Spiff got it. Luno wallet. Spiff got it. Abiola got it. Yeah, if you have a Luno wallet, what we agreed on was that you're going to begin your investment journey by putting some money in your Luno wallet, buying BTC. Okay. So you're going to do a long-term investment of buying cryptocurrency. All right. So we agreed that every month or maybe every week, depending on how you get your money, once you have your income, as you pay your tithe, you also invest 10% of your income. All right. Just do an investment that you're not going to feel. When you put the money, you forget about it. I mean, when you pay your tithe, you literally forget about it, right? You're not going back to your reverend father to say, all the tithe I've been paying you. I need to pay my rent today. Please bring my tithe. Right? So that's what it's like. As you pay your tithe, you do an investment. You take a fraction of your income and also you devote it to this long-term investment plan that you have. All right, so you can do it in form of a Luno wallet. And I encourage you. I said instead of saving your money in the bank, right? That's what losers do. Okay, Robert Kiyosaki said savers are losers. People who save their money in the bank, they are losers, right? So you save your money in an asset class, okay, so that over time you stand a chance of appreciation, because as long as it's an asset class, it's bound to appreciate, even if it's an agricultural product. Okay, it will surely appreciate. All right. Yes. Yeah. Yeah. Peter Shock say I have Luno wallet. Yes. It's not just having the wallet. Everybody can get a Luno wallet very easily, right? Is using the Luno wallet. Okay, I told you that every month I put a certain amount aside. Once I get my allowance for the month, I make sure that I put some investment into these things, and then I eat the rest. Of course, that's why I'm working. I'm working so that I can eat what I want to eat. Okay, but it's stupid to eat it all. All right, a farmer does not eat their seed coin, or seed corn rather. Okay, seed corn is supposed to be planted again. All right, that's what that 10% is. When you make it, it's your seed. If you eat any fruit, there's supposed to be a seed in it. So that seed is supposed to be planted again so that you can continue to bear fruits. All right. So if you have a habit of eating everything, you will soon become hungry. Okay. So have a habit of always saving a little portion. That's what we achieved yesterday. We created a little wallet and then we put some money. I told you, even if it's 1,000 naira, put inside. I had BTC worth 10,000 naira. Within a space of 2 years, it appreciated to close to 1 million naira. Right? That's what happens, with asset classes. It appreciates. Right? So you have to be in the habit of investing. Make it a routine. As you pay your tithe, you invest. And then you eat up the rest. Right? This savings is not saving to pay your house rent. It's not saving to buy food stuff at the end of the month. It's not saving to take care of one problem. It's saving to gain financial freedom. It's saving to be emancipated. It's saving to not touch, right? If you're going to liquidate, you want to liquidate in 5 years' time. You want to liquidate in 10 years' time. All right? So even though your 10% is little or is nothing, in a space of 10 years, 10 years is a lot. And if you have the patience and the discipline to continue that for 10 years, you will be in money, right, in 10 years' time. Okay? All right, so without wasting your time, so today we're going to continue where we left off, right? I introduced you to TA and I told you that some of the principles of technical analysis that prices move in trends. And then if we have established that prices move in trend, we know that market can either go up or come down or stay sideways for a while. Okay? So yeah, that's what you can see. Market going up, staying sideways, right? Here, coming down. All right, so that's the only thing that can happen. And then Elliot said that these waves move in a 5-count wave system. All right, they move 1, 2, 3, 4, 5, and then ABC. And then he says that ABC is just a correction. It's like breathing in and breathing out. The market is moving to one direction, but every now and then is resting. Okay, so that's the way the market moves. These are some of the things we looked at yesterday, and then another principle of TA is that history repeats itself. And then we say, okay, yes, if history repeats itself, it means then that we can make money using technical analysis without actually going to look at the situation of the economy of that country. All right, we can just look at the chart and make decisions. Okay, so we can look at the chart and say, okay, yes, because the price have a habit of reversing from here, it will reverse again. All right. So that's what technical analysis is. So it's a probabilistic event. It's a probabilistic occurrence. It's not set on stone, right? The trade, okay. You can have a scenario where share this now. All right. So you can have several. I have to clear all. Okay, so some people are writing on the screen, so I have to disable that. Okay, yes, right. You can have a situation whereby, you have to take several trades. Okay, you have to take several trades, and then TA, if it's fundamental analysis says that on every trade, right, you will be correct. If I'm trading based on fundamental analysis, right, I will be correct. Okay, if the economy is bad, I know that the currency will be bad. And then if I take trade one will be a winner. Right? Trade 2, for example, Ghana started to improve. And then as Ghana started to improve, CDs gained weight. So as a trader, you're going to bet that CDs will increase over dollar, right? That the chart is going to rise. You will be right because that's fundamental analysis. South Africa, the same thing. South African rand was appreciating for some time as South Africa economy improved. All right, you are going to be correct. That's fundamental analysis. But each of these trades is going to take you a long time to materialize. So if you want to make profit every day, every month, every week, you can't rely on fundamental analysis. You need to do TA. And for TA, guys, for TA on each of these trades, you do not know the ones that will work out. The only thing you know is that history repeats itself. And because history repeats itself, anytime the market comes to the trend line, it's bound to reverse from that point. So when it gets there again, traders say, okay, we are going to buy from here. We will buy here so that the market goes up. Now, it is possible for the market to buy. It's also possible for the market to break out and start moving downwards. All right, so you don't know which of them will work out and which one will not work out. That is the reason, right? That is the reason why, yeah, welcome, Steve. I'm just seeing your message. Welcome. Yeah, that's the reason why we have to just stay neutral. Okay, stay neutral. The only thing we do is, as I'm going to do, is give you a strategy that works very well, and then you put in a little amount each time, so that at the end of the month, your edge will show up, and then you can stay with a little profit. Is that okay? So guys, don't throw away what I've just said. It's very important. Next thing I'm supposed to show you is how you can identify trends. Okay, there are three kinds of trends. Right? There are three kinds of trend. There's a trend that goes like this. Okay, really strong, right? Really strong. Market's going straight up. It's strong. And then there's another trend that is going up, going down, going up, going down, going up, going down, right? Going up, going down, right? Going up. And then there is another kind of trend where market goes up, comes down, goes up, comes down, goes up, like this, like this. All right, so traders see this, they know that, yes, it's an uptrend, but this is really weak. Okay, has lots of pullbacks. So this one, we can call this a strong trend, right? And then we can call this a healthy trend. And then we can call this a weak trend. We know that this is going up, but it has lots of pullbacks, deep pullbacks. So we say it's weak, all right? So take note of that, guys. Those are the three types of trend, because when you open it, remember that technical analysis is the identification of trend. TA is trend identification. All right. The full definition is that technical analysis is the identification of trend and its turning point. All right. So you are trying to catch a trend, and then you are also trying to be smart by knowing when the trend is going to stop and turn. That's what technical analysis is. So it's expedient that we know the types of trends that we have, right? And then there are very simple ways that traders can know what kind of trend they have. Okay, as a matter of fact, there are several things that we can use to know what trend we have. There's something called moving average. Okay, moving average is an indicator that follows price. All right, when I put a moving average and the moving average is heading up. Oh, let me remove that, change the color real quick. If I put a moving average on the price and I see that it's going up like this, it means that it's an uptrend. Okay, it's going up, it's an uptrend, right? Let me show you. Let me open the chart real quick and show you what I am talking about. Okay, so what I'm trying to say here is, if you look at this moving average, the direction of the moving average shows you that the market is buying or selling at every point in time. Okay, so let me explain. In fact, some people will say, okay, when the market is above the moving average, is an uptrend. When the market is below the moving average, is a downtrend. When it goes above the moving average, is an uptrend. Anytime it goes below, is a downtrend. Anytime it comes above, up, goes below, down, comes above, up, goes below, down. So, but this is not reliable for making trade decisions. Is that okay? So you need a lot of other things before you can make a trade decision. You cannot say, okay, since moving average helps us identify a trend, whenever the market is above the moving average, let us buy. Right? If you did that, whenever the market is flat like this, you are going to lose a lot of money, because this looked like an uptrend, but then it came down again. went up, come down. So anytime the market is flat, you will lose money. This one looked like an uptrend. Didn't go quite as high as it should, and then it came down, right? So you can't rely on this to make trade decisions. Is that okay? So, but what you can do is just understand that moving average can help us to identify a trend. And then some people ask me, what is a moving average, right? A moving average is an indicator. Okay, indicator meaning, I'll show you what it is. Now, see what they do, right? If what I have here is an exponential moving average. Okay, it's an exponential moving average 20. Moving average, that's MA. So when you look at it, you see EMA. So this is moving average. So it's an exponential moving average 20, meaning that the moving average here takes, this red line is the moving average. This red line you are seeing is the moving average, right? What it does is that it will take each of these markets have prices. Each of them have prices. Each of them have prices. All right. If this is a Naira chart, you can be seeing maybe 461, 462, 467, 468, like that is increasing. Now, what the moving average is it takes the average of the past 20 prices. If it's EMA 20, it will take the average of the past moving average 20, the past 20 prices rather. So let's say over here, the price is 381. The next bar, now each of these candles have their price. So it's going to take 20 of those prices, 381, 392, then maybe 403, then maybe we get to 461, right? It will take the average of 20 of these prices. Let's say you add 381, 391, 403, 361, 362, like that. You add them up, and then you divide all of them by 20. All right? So the past 20 prices, all right, divided by 20 will give you a single price. It might be, let's say, it might be 395. All right, so if you get 395 as the price, the moving average will now plot a dot to symbolize that the average of the past, let's say all of them, this is the place you stopped, or you took 20 prices from here backwards. It will now plot a dot here as the average of the past 20. Now, when one more price opens, that's another candle opens and closes. This candle will introduce a new price. That new price, now they will remove the last one and add the most recent price. All right, so they remove the last one and add the most recent price, and then they'll plot another point again. So they repeat this process, keep adding these points together, adding these points together. And then what you have is that the indicator will now combine all these points together. Now, you see now, as this current candle is forming, this one here, what the indicator will do is going to now take the average of, once this one closes, or from this one that closed, this is an hourly chart. Immediately this one closed, one dot will be added. Immediately this one closed, another dot will be added. Each of these dots is, remember physics, when you plot a physics graph, you have asterisks, right? You plot them, and then if it's in mathematics, you try to use a broom to connect the best fit. All right, or if it's in physics, you can trace these dots and go. That's what the moving average does. So it will be taking the average of the past prices and then you connect them together. Okay, so what you observe is that it's following the price. All right, so when you have all these dots connected together, you have a moving average. And then a moving average is an example of an indicator. Okay, it's an example of an indicator. And what it does is it shows you where the price is going. And then, like I said, there are two things. It's either you look at this slope. If it's sloped to the upside like this, you say it's an uptrend. Okay? If it's sloped to the downside, you say it's a downtrend. Or better still, if the price, that is these candles, if they are below the moving average, we say that it is a downtrend, right? And then if they are above, okay, some people use MA crossing. Once the market crosses, they say, okay, it's an uptrend, it is above, all right? So that's the use of a moving average. And then look at now, we took the average of 20 prices, but some traders can decide to take the average of 50 prices, right? Some traders can say, okay, let's use 50 prices instead of 20. All right, so when we now say EMA, when you now say EMA, you set it to EMA 50. It's now taking the average of 50 prices, not 20 anymore. So you will see that it's going to be different from the one we have. All right, take note of what I've just said. So you know that there are different types of moving average. And then there are 4 types of moving averages. There is one that is a normal simple moving average. And then there is another one that is called exponential moving average. There's another one that is called smoothed. Okay, smoothed moving average. There's another one we call linear weighted moving average. All right, I'm not going to bore you with all these names. These are things that you familiarize yourself with time. Okay, so with time you get to know all these things. All right, so don't bother yourself so much about it. The difference between all of this MA is that if you take a period of 20, it's considering 20 prices. If you take a period of 50, it's considering 50 prices. If you take a period of 100, you are taking into account 100 prices. All right. So what I'm saying in a nutshell is that if I come to the market here now, and then I adjust my settings. Okay, these are my indicators, and I take a moving average, and I say moving average with period 50. Let me make it a little bit thick so that you can see very well, and blue, right? So I do this. You see, this is moving average 50. Okay, so you can see that this one is 20, is closer to the price. This one is 50, is farther away. If I use 100, it's going to take the average of 100 prices, right? It will take the average of 100 prices. So that's what happens when you adjust the settings. And then when you design your trading system or you design your trading plan, you can now say, okay, let me use indicator moving average 20. So that anytime the price pulls back to moving average 20, I buy. Anytime the price pulls back to moving average 20, I buy. Anytime it pulls back to moving average 20, I buy. Right? Some people do that. Some people say, okay, no, let's use 50. Anytime the price pulls back to moving average 50, I want to buy. Anytime the market pulls back to moving average 50, I want to sell. Is that okay? So anything that works for you will work. All you just need to do is look at the charts and then look at that thing and see how often it worked and if it worked well. Okay, sorry about that. Yeah, there's nothing that determines the number that you use. You can use any number depending on what you want. But I just want you to put it somewhere at the back of your head that if the market is respecting, when I say respecting, what I mean is if the market is pulling back to a 20 moving average and bouncing from it, you have a strong trend. Okay, so if you want to identify a strong trend and you open your chart and you see something like this, market is pulling back to the 20 moving average and bouncing away from it, you know that what you have is a strong trend. Market is going straight up. All right, that's for a 20 moving average. That's the red line I have. Okay, if you want a healthy trend, a trend that goes from support to resistance, the market usually respects the 50 moving average. So when you look at this now, you see that from here, support turns to resistance. The characteristics of a healthy trend is that support always turns to resistance. Support is the area where the market bounces from. It's like the floor and the ceiling. Okay, from like bouncing a ball from the roof of your house to the floor. Okay, so you bounce it, it goes up, down, up, down. That's support and resistance, the floor and the ceiling. Okay, and then if the market is moving in a trend, the floor can turn to the support can turn to resistance. For example, look at here. This area, what I have here was at some point, market was bouncing between, okay, so at some point here, right, you observe that market was bouncing up, down here, right? So it was going up, down, right here, right, until it broke out. And then when it broke out, it came back, and then initially, this area down here, we call it support. All right, and then this area up here, this is not an ideal one, but market is bouncing from here. We say that this is a resistance. Okay, so this resistance is going to be the ceiling. So it's like bouncing the ball up, down, around here. All right, so this is a support, this is a resistance. All right, so for a healthy trend, resistance becomes support. So when you see here now, what you see now is that this is a new floor. So we call this support. And then this was formerly resistance. All right. And then if you observe the moving average, you see that the market is respecting the 50 moving average, at least to an extent. Okay, before it started to disobey it. Here, where you have this choppiness, right, around this area. So once the market stops to stop respecting the 50 moving average, you know that you have a weak trend. All right. So at this point, you say it's weak. Here is weak. At this point, you say it's healthy. All right. At this point, you say it's strong. So you can see that the market is changing from a healthy trend to a weak trend to a strong trend. Strong trend. Sometimes traders call strong trend a breakout. Okay, they call it a breakout. All right, that's a strong trend. It has little or no pullback. As a matter of fact, instead of having pullbacks, what it has are flags and pennants. I'm going to teach you all of this. And then when you have this kind of scenario, what you have is a measured move. The length from here to the length to this side is usually the same, right? From here to here, after this pennant forms. So this is a strong trend or a breakout. I'm going to teach you how to trade a breakout. I'll teach you. All right. So please take note of that. This is going a little bit deep. I can understand that. All right, but that's what happens. I mean, when I start to talk, okay, before you know it, I'm already thinking that you're already traders, and then I start to teach you a lot of things. So, but I'm going to go back to my slide so that I can maintain the presentation within the scope of the class. All right, so what I want you to take out from what I'm doing for you right now is that we can identify a trend by introducing this moving average. These moving averages, they are called indicators. If you want to put them in your chart, and you're using a phone, there is something on your MT4. MT4 is that blue app. You see where they wrote F. So when you press that F, you see a list of all the indicators. You see moving average, stochastics, MACD, all those things. And then there are two things you can put on your chart. You put either an indicator. Indicator is anything you put on the price. If I introduce an indicator is something that is calculated to show you a pattern that the market is following. All right? It will show you a pattern that the market is following. That's an indicator. Anything you put at the base of your chart, all right? When I say base, at another window at the base, all right, it's called an oscillator. This is an oscillator. It goes to and fro, simple pendulum. Oscillators go up, down, up, down. And what oscillators are doing, or the work of an oscillator, is to tell you that, okay, this market has gone too low. Now it's about to go up. And then when it goes up, we say, okay, it has gone too far up. It's going to come down. And then when it comes down, we say, okay, it has gone down. It's going to go up. So that's the work of an oscillator. So there are only two things you can put on your chart. Either you put an indicator, which you put directly on the price, or you put an oscillator, which comes usually at the base of the price. Please take note of all of this, all right? Just for, knowledge sake, so that you can know the right things. All right, so I'll go back to my slide. So there are many ways that traders usually can identify a trend. I have only told you about this one here, which is a strong, a moving average. There's something we call parabolic SAR. Parabolic SAR will tell you that anytime that the market, when the dot starts to appear at the base, just know that you have an uptrend. So all of these are indicators. All right, I'm going to show you what I mean. And then you can also have rising or falling tops and bottoms. All right, and then lastly, what traders just observe is a trend line. A trend line, by looking at it with your eyes, you can tell, okay, this market is going up. Okay, you can be as simple as that. You look at it with your eyes, and then you can tell yourself, yeah, the market is going up. Is that okay? So I'll go back so that I can show you all the ways of identifying a trend. I am taking my time on this slide because this is the basis for technical analysis, trend identification. As a matter of fact, when you start to trade, you must be able to put in something on your chart that tells you where the trend is going. And you do not take a trade in the opposite direction. And you make sure that the thing is clear. It's clearly telling you it is going up. And then when you see that, okay, yes, this parameter has been met, that the market is going up. Now I am looking for an opportunity to get in and buy. What traders will normally do is, once they see that, oh yeah, the market is up, what they are looking for is an opportunity to buy when the price comes down. Okay, when the price is cheap, they try to buy so that they can take 1:2. Okay, so I'm going to show you some of these things now. All right, so again, I told you that ways to identify the trend. You can use a trend line. That's the simplest way to identify a trend. A trend line is just a line under the price that shows you, where the market is going. the slope of this trend line is going up. It shows you that this market is an uptrend. All right. So that's one way to identify a trend, using a trend line. All right. So you can use a trend line. All right. And then, of course, there's also a trend line on the opposite side. But what we call this one on this other side is trend channel line. So just take note of that. Okay. Trend channel line. And we call it trend channel line because it puts the price in a channel. Okay. So this is the trend line. And then the one up is the trend channel line. Take note of that. All right. So that's a trend line. And then usually what traders do is they say, okay, yes, if the market touches this trend line once and comes back and touches it again, if it touches it the third time, I will buy. And I'm going to buy this small candle here that confirms the reversal. And I'm going to factor in 200 naira into this trade. When I say 200 naira, I'm assuming you have an account size of 10,000 naira and you want to use 2% on each trade. So that would be 200 naira. So you tell yourself, okay, market has touched this trend line. This is 1, this is 2. Now, once the market comes back to touch this trend line, I want to buy. So I'm going to buy here, put a stop loss at the base of the candle, so that if I get twice the height of this candle, somewhere around here, I will take my 400 naira profit and leave the market and wait for another opportunity. Once the market comes back again and touches the trend line, right, I'm going to buy. When I buy, I put a stop loss here. Once the market moves twice as high, I put 200 naira here. The market goes twice as high, I will take 400 naira and leave. You can see this is an effective strategy. Okay, market comes back, touches the trend line, but this time around, instead of reversing, it did not reverse. What did it do? It break out to the downside. And then what do traders do? They do not take any trade. So once the market comes there and bounces, there are two things it's going to print, which is the next thing I'm teaching you now: an indecision bar and a trend bar. So when you see an indecision bar like this, followed with a trend bar, you know that the market is about to go up. I'm going to teach you what indecision bar is and trend bar. That's the next thing I'm supposed to teach you when I teach you how to identify a trend. All right. So we're going to come back to this particular chart so that I can show you how to use it. Okay. So in the meantime, you know that you can identify a trend using a moving average. Can use a moving average, right? To say, okay, my basis for knowing that the trend is up is a moving average. You can use a trend line and say, okay, yes, I can decide that, okay, my basis for understanding or knowing that the market is an uptrend is to use a trend line. You can use MACD, guys. You can use indicators and oscillators. Indicators/oscillators. Can use indicators and oscillators. Usually, we always say when MACD is positive, you can see that there is a middle line here. There's a middle line here. There's a middle line here, right? If this bar, this histogram goes above, we say it's positive. If it goes below, we say it's negative. And then traders will say, okay, anytime the histogram bar is above this line, this is a MACD. This indicator is called MACD, MACD. All right. So they say that, okay, when the oscillator is above the midline or the midpoint, is a buy. It means that the market is in an uptrend. And then whenever the market is in an uptrend, we say that the market is bullish. And then I'll tell you why. Bulls, whenever they want to fight or attack their prey, they use their horn, right? You know, to drag up. All right. They use their bulls, their horn, rather. They use the horn to lift you up. All right, that's what a bull does. So whenever the market is going up like this in an uptrend, traders will say that the market is bullish, or they say I have a long position. All right, so take note of some of those terms. I'm introducing them already. All right, and then when the market is in a downtrend, when the market is coming down, all right, market is going down. Traders say that the market is what? Bearish. Okay, the market is bearish, meaning that the market is in a downtrend. And then traders will normally say they have a short position. Short position means that they are selling. All right, they are selling the market. All right, long position means that they are buying. Okay, so if somebody asks you what is your bias on Euro GBP, some traders would say, okay, I'm bullish on Euro GBP, or I'm bearish on GBP JPY, right? So those are some of the terminologies. Short position is selling. Long position is buying. Bullish means to buy, going up, uptrend. Bearish means to sell. Bears, you know what bears are now? Bears, they use their paw, their hand. All right? A bear usually uses his paw to draw you down. Okay, so that's the way they operate. They will use their paw to drag their prey down and eat it up. Unlike the bull will raise you up. Okay, so yeah, that's Those are the types of trend, their names and all of that. And then another thing you can use to identify a trend is there's something we call parabolic SAR. Okay, parabolic SAR is an indicator. There are many indicators, and I cannot go over all of them, obviously. So what I'm going to do for you, is somebody's asking EMA, what is whether EMA or SMA, which one is better? Well, I prefer using EMA because EMA usually makes reference to the current price, and then a little test will show you which one is best. A lot of traders use EMA because if you use an EMA, right? If you use an EMA, let's say the price is going up now, and then the new price starts to go really high. If I have an SMA, you can see that the hour bar just closed and then a new one is forming. If I have an SMA, for example, SMA is going to be slow. You see, even though the new price now is very high, SMA will take a long time to turn. That's SMA, right? This is a smoothed moving average. But the exponential moving average, see what it would do. If I have an exponential moving average on this chart, exponential moving average will be following this price, right? Because it's exponential, it makes reference to the current prices. So once the market starts to spike up, you see that the EMA will move fast. So this will be EMA. You can see that it moves very quickly. It turns very quickly, unlike the SMA. So this is EMA 20. This is also SMA 20. But see the reaction to the change in the price. SMA took time, or is taking time to turn. But EMA turned very fast. EMA turns faster. It turns faster, unlike the SMA. And then what about linear weighted moving average 20? If I put a linear weighted moving average hardly turns. It stays flat. Because it has a linear nature. It stays flat. So traders, when they use linear weighted moving average, what they are interested in is the price above the linear moving average or below. As a matter of fact, I'm going to introduce you to a strategy where we are going to use linear weighted moving average 50. And then we are going to say, okay, let linear weighted moving average 50 be water. Let it be water. Let it look like the surface of water. So that if the price comes above it, it looks as if the price is about to dive. And then if the price goes below it, we know that it's like a fish that just dived. And now once the price comes below, we are selling. When the price comes above like this, we are buying. Okay, this will be a linear weighted moving average 50. I'm going to teach you a lot of things, guys. So just stay with me, guys. Stay with me. I have a lot to show you. And then usually after all of this, you would have taken a lot of information, and then you will be able to design your own trading plan and make money with it. Okay. So in the meantime, just stay with me while I unlock all of this. All right. Before I started showing you about this, answering the question the young man asked, I wanted to show you the parabolic SAR. And then that was me trying to say, okay, the market actually makes reference to many things. This is the parabolic SAR, these red dots that I just introduced to my chart. All right. And then the way it works is that we always say that anytime the market, let me delete these moving averages. Okay. Now see these dots. What traders do is they say, okay, once the market is in an uptrend, immediately the thing comes down. If it starts to go up, we have this dot switch from up to down. Once the dot is down, traders believe that the market wants to rise, so they buy. And then you can see they buy. Once the dot stops, now goes down. It goes up, they sell. They say it's a downtrend. It goes up, but you can see that whenever the market is in a trading range like this, when the market is flat, you lose a lot of money, right? So usually traders do not use only one indicator. They combine several things. They might say, okay, let's use histogram of MACD. If the histogram of MACD is positive and this is below, we want to make sure it is below. Histogram of MACD is up, positive, right? All the histogram are positive. Then if that is the case, then we are now saying, okay, let us buy. All right, so there are several factors that you might want to consider. Is that okay? There are several factors you might want to consider before you place a trade. All right, so traders filter it out. But as a rule of thumb, do not have more than 2 indicators on your price. Anything more than 2 is not necessary. If you have a trend following indicator, you don't need more than 1. So and then for an oscillator, you do not need more than 1 oscillator. at every point in time. So there's something they say, keep it simple, stupid. That's KISS, right? Keep it simple. All right, keep it simple, stupid. All right, so you don't have to bring in all the indicators in the world to know whether to make a buy or sell decision. All right, what you need is, what is the purpose of the indicator? Is it to identify trend? Is it to know when the trend is the correction of the trend is over and the trend is about to turn? All right, so you just need one or two, just one usually. All right, so you got to keep it as simple as possible. All right. Okay, guys. So yeah, this is a parabolic SAR. All right. So that's another thing that traders can use to identify the trend. Is that okay? Something traders can use to identify the trend. All right. So going back to the slide. So yes, the most basic thing you can see, I even didn't tell you the most basic thing. The most basic thing that traders also use is as simple as looking at the market bottoms and tops. Let me show you what I mean. Right? Something as simple as looking at tops and bottoms. Okay, so what traders also look at, they say, yes, in fact, the definition of an uptrend is simply two successive, right? We call it two successive rising bottom. And then a downtrend, we call it downtrend two successive falling tops. Okay, so what I mean is this: market goes up, comes down, goes up. This is an uptrend. This is a bottom, and then this is another bottom. This one is higher than this. So traders say that the market is in an uptrend. It's as simple as that. Don't make it complex. If you look at the chart, you should be able to know where the market is going, whether it's up or down. Trend identification is key. If you have tops, top, and then these tops are falling. This top, of course, you can define based on bottoms or based on top. If I have tops that are rising, also, I have an uptrend. Okay? This is falling tops. When the tops are falling down, traders say that it's a downtrend. All right, so that's how to identify a trend. At least two. When you have two, at least, you know that you have a downtrend. And then I'll tell you how traders usually trade. See what they will now do. They will now say, okay, if we have two rising bottoms here, market touches this trend line and bounces, and then it goes up. We draw the line and wait. Since this is the genesis of an uptrend, we now say, okay, let us wait and observe and see this market pull back again. So, and the market has inertia. It will keep doing what it has been doing. The moment the market comes back to this trend line, and then it prints candles that shows that it's about to go back up, right? Traders are ready to buy. All right? So what a trader does is the trader will now say, okay, I'm going to put a stop loss here. I'm going to put an entry here for a buy. And then I'm going to measure from here to here, from the height of this place to this place, 2 times to be my target. So they factor in, this will be the target. What they do is they factor in 2% here, 2%, 200 naira, so that they make a profit of 4% here, which is 400 naira. That is exactly how traders trade. All right, so when you have two rising bottoms, all right, you have a trend line. The moment market comes back to that place, traders expect the market to continue buying. And then when it gets to this place, it triggers their target. All right? So every time the market comes back to the trend line, traders want to sell if it's a downtrend. They say, oh, there are 2 points successive. And then we draw the trend line and wait. If the market comes back to it, we sell from this point and then take our profit somewhere here. So you have a trend like this. You don't want to go and sell here at the top. You want the market to pull back. So you enter in the correction. The problem we always have is we do not know when the correction is over, and we don't know how long the correction will take and where the correction will reverse from. So because of this, we lose money. And since we do not know, anytime we are taking this trade, since we have established that we have a downtrend, anytime we are taking this trade, we have to use 2%, so that if this market doesn't turn as we expect it to turn and it continues to go up like this, right? What traders say is, okay, they lose just 2% of their account size, which is nothing. If they later go and then find another trade and then they make money, they make 4%, which is covering up for the previous losses. So you do this repeatedly throughout the month, you see that you make money. That's the only way to trade and make money. I keep on saying it. All right. Yes, I keep on saying it. There are, of course, there are many strategies. This one I have given you here is a strategy on its own. Can trade based on the trend line. All you need is market touching the trend line and a confirmation around the trend line that the market is about to resume. It's a strategy. You can use it. Okay. So, but I'm going to teach you something a little bit deeper now. All right. So let's now look at bars. Okay, guys. Let's look at bars. So yes, take notes. Take notes. I'm sure you know what a trend is, and you know how to identify a trend. You know what an uptrend is called. You know what a downtrend is called. Okay. You know what support and resistance is, guys. Support and resistance, I'm going to give you in details in the subsequent classes, right? I'm going to give you in details. Yeah, that's very good. Thank you. I like to see your feedbacks. And Dennis, thank you. All right. So I'm going to give you in details what support and resistance is. Is that okay? The class in January, we're going to go into details. We follow a scheme of work where we touch every part of it, and I tell you how to do it correctly and how to place trades based on it. Okay, give you a lot of detailed information and organized information. All right. But for now, I just need you to get the concept, okay? Because I don't want you to attend Pip Surgeon's seminar and go home and still not know what you need to know about the basics of forex trading. Is that okay? So yeah, support and resistance is, I told you, if the market comes to a particular level, right? Market gets to this place, comes down here, goes back, comes down, goes. This place is now support, and this place is resistance. That's what support and resistance is. And I also told you that they can change. If this market won't stay here forever. It won't stay inside here forever. After some time, you will see that it will break out. And then when it breaks out, it can continue again like this. And then you see that this thing that was resistance, this same line that was resistance before, has now turned to support. That's turned to support. And then now resistance is now going to appear somewhere up here. So support can flip to resistance. All right. And resistance, when it's a downtrend, resistance usually, when it's a downtrend, support can flip to resistance. Resistance, when it's an uptrend, can also flip to support. So you can see resistance here changing to support. All right. It's very, very possible. Market goes up, breaks out, come down. And then you see that what you have here is resistance turning to support. All right. So this is resistance and support. But I'm going to teach you how to know resistance and support in the market. All right. So you see these traders on CNBC, what they tell you, they say the market is at support and I'm going to buy. All right. And then I've told you what a trend line is. When you draw a line like this, what you have is a trend line. All right. It's a trend line. And then I told you the one opposite is a trend channel line. All right. So this is still support and resistance. All right. So sometimes traders can say, okay, the market is at support, I'm going to buy. Right? Markets at support, I'm going to buy. Okay. Yes, it will. All right. So traders say, yeah, the market is right here, I want to buy. Okay. So this is what they are referring to. All right. But this support and resistance is not flat. So as a matter of fact, trend line is like support and resistance that is tilted. Okay. When I say tilted, I mean slanted. Right. So it's almost still the same thing. Right. So take note of that also. And then do not trade a reversal trade unless the trend line breaks. What I'm trying to say is if the market is going up, we expect that the traders who are defending or who are having the bulls are not supposed to allow this trend line to be violated. Once the market touches this trend line, we expect it to move up. Once it touches the trend line, we expect it to move up. Once it comes back to the trend line, we expect it to move up. So if they violate the trend line, traders expect the market to reverse and move to the opposite side. So this is the only time when traders are allowed to trade a reversal, when the market is in an uptrend, when there is a violation of the trend line. And then when you do it, make sure you accept at least twice. Don't ever go below, because market has inertia. It will keep doing what it's doing. If you're going to take a bet that the market is going to stop doing what it has been doing, you must be willing to take a high reward. As a matter of fact, I will not take 1:2 on a reversal trade. If I establish that trade is a reversal, I'm going to take at least 1:3, 1:4, 1:5, 1:10. Because I am hoping that a new trend is about to start to the downside. So if I believe a new trend is about to start, I'm risking some money and I'm hoping that I can catch the whole trend. So please take note of this. Do not on any occasion accept anything less than 1:2 when you're taking a reversal trade. Reversal trades are 40% win rate. Usually, you cannot have any reversal that has a win rate of more than 40% because the market is moving up and you're saying it wants to move down. That is difficult. So it is stupid to see the market in an uptrend and you are thinking of selling. That's counter trend traders. It's rubbish. If you establish that the trend is up, the only thing you are looking for is a discount price so that you can buy. And then if you must take a reversal trade, you are only taking a reversal trade when you are sure that the trend line has been violated. It means that the bulls have been defeated. Now the bears are in control. Take note. A trend following strategy usually is 60%. 60% because the market is already in a trend, it's going up, it will keep on going up. All right? And then why it will keep on going up is when people try to counter the trend and then the market shows up, beat them, they will give up. And when they give up, they will close their selling trade. And when you close a sell trade, you are buying. And then when you buy, you are forcing the market to go up higher. I'll give you more details in our subsequent classes. I'll give you more details, guys. So just take note. Market moves in trend. When it goes in trend, it will break out, go in a range. And then when it goes in this range, it can now choose to either go up or go down. So what you have, uptrend, trading range, market stays flat. When it stays flat, it gets to the point where it makes a decision to go up or go down. This is a market cycle. All right? Market doesn't stay in a trend forever. It doesn't stay in a trading range forever. It also doesn't stay in a trend forever. A trading range doesn't last forever. It will break out to the upside or to the downside. Take note of that. A Forex chart represents, if you see your box, what you have here is the price. And then what you have here is the time. Okay, so everything you see on the chart is a representation of the price changes. You can have a simple line like I just did, or you can have bars. And then this whole thing started with a Japanese candle, these bars. I'll show you, and then I'll explain what bars are. Once I explain what a bar is, excuse me. Once I explain what a bar is, the next thing I will do is to show you the strategy that you can use to place a trade. So if we do not have enough time to place a trade today, tomorrow morning we will now begin to place a trade. And then I will also show you how to predefine your risk so that whenever you are going into the market, you do not risk or lose more than 20%. All right. So those are some of the things I'm going to show you. Okay. And then before I show you that, I will take you through my slide so that I know that I've completed the slide and all the terminology so that when I start to teach you predefining your risk, you can flow with me very well. Is that okay? All right, guys. Okay. So yeah. I have to take you to the chart so that I can teach you Japanese candlesticks, bars. The way I teach bars. Okay, yeah. 2%, not 20%. Thank you, Messi. Thank you. 2% per trade, not 20%. Obviously, not 20% per trade. Okay, so let me share my chart again with you. The market. All right. I'm going to wipe out all the indicators on this chart so that you're going to see just the price. And I want you to listen very, very well because I'm about to teach you good. Those of you who do not really know too much about this, you can learn everything you want to learn in this particular presentation. Okay, because I'm going to be teaching you a lot of important things right now that will be important for your foundation. All right. Now, this is what I was trying to say. Now, I have explained what a simple chart is. Charts will show you the time. Okay, so what you see here is 8th of December, 9th of December, 10th of December, 11th of December, 14th of December, like that, the time, and then the price. In layman's English, what this thing is that we're saying that if this is Naira versus dollar, okay, if what we have is Naira versus dollar, yeah? All right, if we have USD against Nigerian Naira, which is equal to, let's say, 482.35. What you'll be seeing here is 482, 483, 484, 485, like that, 486, right? maybe from here you have 3 something, 3 something, 3 something like that before you go to 4 and like that. So here, what you have here is the price. All right. So what you do, and then what you have here is the time. And then what you need to know, guys, is that if you want to know what a specific price is, you put a horizontal line. There is a horizontal in the tool here. These things are called tools. All right. So this one is the horizontal tool. You take it up. When you pick it up like this, if you pick it up, you can take it to your chart. You can see that's mine. All right. So when I put it here, you can see that the price of this currency against the other one at this point is 0.904. So this is important because whenever you want to give prices to your broker, you have to actually take this, you have to take it like this and then place it so that you will see the specific price to the decimal point where you want to buy and where you want to sell and where you want to set as your stop and target and the rest of them that. Okay. So please take note of that. It's very important. All right. So on your phone, if you want to bring out this, you're going to just tap the home screen where you have the price chart like I have now. You will just touch the screen. Once you touch the screen, you're going to see a cycle come out. That cycle usually will contain several tools and time frame. It's going to be blue. All right. So you see a blue cycle come out. Something like this will come out on your screen. All right. And it will have all these different indicators, not indicators, tools. You're going to see time frame, 5 minutes, 1 hour, H4, daily, right? And then you also see something like shapes. So if you want to bring out this horizontal line like I did here, just click on shapes. This is the one that has shapes. When you click on shapes, you see where it's written horizontal line, vertical line, trend line. They are written there. Okay. So you pick the one that you want. And then you use your finger, place it on your chart. Once you pick it, you will see that it will be highlighted here. If it's a horizontal line, you see a horizontal line appear on your screen. So once you touch your screen and then you drag it, that horizontal line will be moving as you drag your screen. It will be moving up, down as you drag your screen. Okay. So take note of that. If it's a vertical line, it will show something like this. If it's a trend line, you're going to see something like this, showing you that it's a trend line. All right. So these things are not difficult. It's just like buying a new smartphone. You get used to it. All those tools and everything, you understand how to operate it with time. It's not difficult. Okay. So the main thing are these informations I'm giving to you. All right. So yes, now that you understand what the price chart looks like, what traders usually would do is they will now say, okay, some traders use line. So you can see this line, the red line is the price. So the price at the end of the day, that's what they plot on the chart. So the price at the end of the day, that's what they plot on the chart at the end of the day. So they now say, let's say yesterday it was rice. Yesterday, or let's say this is a daily chart or a monthly chart. Last month, rice was maybe 32,300. Then 2 months ago it was. So the prices, as the price changes, they put it here. So the price every month, at the end of every month, will be represented here. There's a monthly time frame here. You can change to monthly if you want. This is monthly. Every month, the price at the end of each month. They put it and then they connect it to form a line. So traders look at this line and say, okay, the price is rising. All right. Now, there's a Japanese rice seller that wanted to, the price throughout the course of a trading day varies. There's a price at, like buying bread very early in the morning. There are people that will sell bread very, very early in the morning. These guys, they come out and they sell the bread very cheap. Before daybreak, that same bread, maybe the loaf of bread is supposed to be 500 naira. Very early in the morning, you can buy that same loaf of bread at 250 or 300. When it is daytime in the morning, some people will, after buying that bread at 250, they will sell it 300. Some people will sell it 350. Some people will buy this bread, they take it to a big eatery, you can sell it for as much as 500 naira. All right? And then usually before the end of the day, that same day, just so that the bread will not spoil, some people will say, okay, take for 400 or take for 300. And then the next day they go and buy again. So you see that this price is changed. I'm going to describe something for you now, guys. So let's say we're using bread, right? Or let's use rice. Now, what we call Japanese candlesticks, right? These Japanese candlesticks were developed by a Japanese rice seller. All right. And then the price of rice, he has a farm. All right. So when he, as a farmer, the price of the rice early in the morning could be let's use example. Let's say it's, the current price is now. I believe that rice is around 30 something thousand naira. So let's say very early in the morning, the farmer, for those that will come out with their truck early in the morning, he can sell to them at, let's say, 28,000 naira. All right, very early in the morning, and then these people will go home. Okay, the price started at 28,000 naira. So these people will go and say, okay, no. Let's do it this way, so that you can have all the four areas that we need to make reference to. Yes, I'm still going to use the same information. The price early in the morning is 28,000 naira, but there are some people that can buy in trucks and containers. So when these people come that early in the morning, he will reduce the price from 28,000 naira per bag to 26,000 naira. Okay, so he sells to them at 26,000 naira since they are buying a lot, right? Now, these people will buy and all of them will carry it to the market. Some people will take it to the market in the neighboring village. They sell at 30,000. Some will sell at 32. Some will eventually sell at 33,000 naira, right? So you see that the price, the same rice that they bought, or the same rice that had a price worth 26,000 naira, also has a price worth 33,000 naira. It depends on who is buying and where the person is buying and from whom the person is buying. So you can have all these price changes within the course of the day. Early in the morning, when the price opens, it has a price. If you're buying large quantity, there's a discount. And then the prices go all the way to 33,000 naira. And then you see some traders, who will eventually, maybe at the end of the day, because they want to go back to the market. I don't know if you go to the market where you see these market women towards the evening. Most of these vegetables are not fresh anymore. Right? What they tell you is, oh yeah, bring 100 naira, let me give you everything. So that could happen. All right, these people who sell the retail rice can now say, okay, they are in the market, they're selling this rice in the wheelbarrow and they want to go back home. So they say, okay, pay so amount and collect everything. And then maybe at the end of the day, they might now say, okay, pay me 30K. These people bought at 28,000. Pay me 30K. All right, and take the rice. So what you observe is that we had 4 different prices for that same rice. At some point we sold here, some point we sold here, some point the price was here, some point the price was here. So you see that there are 4 information. So we need 4 prices. And for traders to make their trading decision, they need these 4 information. You cannot represent these 4 information on the line graph. The only thing you do is the close of the price. What was the last price? You now say, okay, last price was 30,000, they plot it. Last price was, as a matter of fact, this is the way they were plotting. Around 1930, very early, when traders did not have phones and all these electronic devices to plot price, what they did was they take the price from the newspaper. So they buy newspaper every day, and on the newspaper, the prices of everything is published. Rice, cocoa, sugar, everything is published. So they get the price for that day and then they plot it on the graph. The next day they plot it. The next day they do it on a white sheet of paper. So every day they plot it. Every day they get the price, they plot it. Every day they plot it. Every day they plot it. And then what they see is, at the end of the day, they now connect all these lines. And then they will now say, okay, these are the prices for the past 25 days. It means that this commodity is appreciating, is in an uptrend. I don't know if I'm making sense. All right. So this is what they used to do. So we have the privilege now of seeing this thing here like this. It's a privilege, guys. It's a privilege. Right? It's a big privilege that I don't have to look at the newspaper to know that today GBP USD was so price. And then I have to now plot it and then come and connect the line and see whether we have an uptrend or a downtrend. See whether we have a discount that has pulled back to the trend line. No, this is a privilege, guys. It's a privilege. So this is the way they were doing it. And then later on, it was the Japanese guy that now said, okay, since we have different prices we have different prices. This Japanese rice seller was a trader. He now realized that there are 4 prices. So let us design something that can give us these 4 information at a time. All right, that was what led to what we call candlesticks. So what traders now started doing, now some traders, instead of using lines like this, they take the 4 prices and represent it in a bar. So it's called a bar chart. All right. So I'll change this to a bar now. You see what I'm saying. So you see that this is a bar. So let me zoom in a little bit. Look at each of them. You see that they look like this line I drew here. Look at each of them. All right. You see that they have this opening price, the lowest price, the highest price, and then the closing price. That's what they have here. You see, opening price, lowest price, highest price, and then the final price at the end of the day. All of them. So these are called bars. These are called bars. So we call this a bar chart. The previous one that have lines is called line chart. And then the next one that was designed by the Japanese candle seller is called a candle chart. Okay, that's the next one I'm going to change to. It's called a candle chart. All right. So yeah, the next one. I'll change to candles now. So you can see this is candles. So what you observe here, guys, is that this thing looks like it has a rope down, and it has another rope up. See, rope down has rope up, rope down. That looks like candle wicks, the wick of a candle. And then this is the body of the candle. All right. So what I want you to know here is that what the seller did was he just designed something that was going to help traders to see the four prices at every point in time. What are these four prices? I just mentioned them. You have the opening price. You have the low price. That's the lowest price. All right. You have the highest price. And then you have the close price. And then which of these is the most important information? Which of these is the most important information? Let me hear your answer, guys. Which is it, the opening price that is important to traders, or the lowest price, or the highest price, or the closing price? Which one is the most important to traders? Let me hear your answers. The close. Bishop said close. That's very correct. The closing price is the most important. And I'll tell you why. Closing price is the most important, guys. Very, very important. The closing price is important because it defines whether the bar is a buy bar. When I say buy bar, I mean bullish bar or a bearish bar. Okay, so if the close, if the market, let's say the market opened, moved up, came down, right, came down and closed here. If this is the close, what it means is that this is going to be a downtrend bar. This is going to be a downtrend bar. So the close is very important. Close is very important. If the market opened here, came down, went back up, and then this was the highest price. The highest price was 33,000, and nobody was willing to sell anything below 33,000. What you observe is that the high and the close are at the same price, 33,000. Why the close is important is because if the high and the close is very close, it means that if nobody is willing to sell rice below 33,000 anymore, there is a high tendency that in the coming days, rice can rise to 34,000 or 35 or 36. You go to some shopping malls, rice is 37,000. The same rice that you can buy at 32,500, 36,500, 33,500. Some people sell at 36,000. If nobody's willing to, this thing is called rejection. If nobody's rejecting this 33, taking it back to maybe 26 or 28, they keep the price at 33. People are comfortable buying at 33. There's a tendency that the demand and the supply will become imbalanced, and then the price will rise again. So if people continue to request for rice, and of course, there's just a fixed amount of rice that is produced right now, because unless they start importing rice. So we only have a fixed amount of rice right now that's available to buy or to the public. So when demand continues to increase, the price will increase. So that's why the close is very important. And then let me translate this information to a candle. The Japanese candle guy took this information, right? He took this whole thing, and then he now said, okay, fine. Let us say we have this. I want to wipe out everything so that I have more room and then a cleaner space, working space. All right. So now let us say that. Just a minute. Okay. So it's not working as I want it to work. All right. Now let us say that this was what he observed. Okay, price opened at 28,000, went low to 26,000, came up 23,000, and then eventually it stopped at 30,000 naira. Now see what traders now, see what the Japanese guy now did. He now said, okay, let us represent this thing like this. He took something that looks like a candle. He now said, okay, from here, which is the high, right? We're going to have something like this, which is a wick, and then this is the close, right? So he now went all the way to this point. From this point again, he now had the candle body. So he now called this the body of the candle. So this is how he drew it. so that here will be the low, which was 26,000 naira. Here will be the opening price, which was 28, right? And then here will be, this place is the close, which was 30,000 naira, and then here will be the high, right, which was 33,000 naira. So this is what a candle is, and then we call this part the body of the candle, and then we call this wick. Okay, that's the wick of the candle. All right. So this is like the rope inside the candle. That's the candle wick. And then this candle wick is used to show how far low the market went that day, how far high the market went. And then this place is showing you what price was accepted. Okay. And then of course the wick shows rejection, guys. It shows that the price was rejected around that area. All right, so if the market opens, goes up, and then eventually traders don't like that price, and then they come and bring the price low. What you see is, if I represent this as a candle, what you're going to see is a red candle that is like this. So what you see now is that this is the accepted price, and then all of these were rejected. People did not like, they didn't like the price. So it went from maybe 28, and then it rose. Let's say Buhari now said, okay, let's open Lome border, let's open all the borders that we have closed so that we can accept, or let's just allow people to import rice. If people start to import rice, you see that the price of rice will drop back to, let's say, 20,000 naira. All right, and then you will now see that the candle looks like this, showing rejection of 36, 37, 34, 35, 32, rejection. Take note of that. And then again, you can have this scenario to the downside. All right, if it's a bullish candle, this is a bullish candle, even though I'm using a red marker, this is supposed to be green because it's a buy candle. So when the close is up, it belongs to the bulls. Every candle belongs to somebody. All right, and I'm going to teach you that there are only two types of bars. It's either you have a trend bar or you have a trading range bar. There are no in-betweens. If the bar is small like this, okay, the relationship between the wick and the body of the candle is little. It's a trading range bar. But if it's looking like it belongs to somebody, whether the bulls or the bears, let me use green to represent buy, or this, right? Whether it's this or this, you know that this one is a trend bar. And I'll show you what I mean by trend bar. I'll show you. Now, let's assume that, let's say that the market is going up like this. Market is going up. I want to show you what I mean when I say a trend bar. If the market is going up like this, look at what it means. Now remember, let me tell you something very important. This whole information I gave to you happened in one day. Okay, it happened in one day from my analogy. Now, this whole thing can happen in 1 hour. We can have the highest price, the lowest price, and the opening price, the lowest price, the highest price, and the close within 1 hour. That's why you can make money very fast, because all this information can be represented in 1 hour. As a matter of fact, if you look here, you see this 1 minute, this 5 minutes, this 15 minutes. So each of these candles, if I go to, let's say, let me go to a 1 minute time frame, right? 1 minute time frame, guys. What you observe is that each of the candles here in this 1 minute time frame, each of them, it will take 1 minute for this candle to form and close. So you can have high, low, open, close within 1 minute. High, low, open, close within 1 minute. High, low, open, close within 1 minute. After 1 minute, this bar will close, the next one will form. It can happen within 1 day. I can change this to daily time frame. It takes a whole day for one of these candles to form. It takes a whole day, right? It will take 1 full day for this to form. So you got to take note of this. Very important that you take note of this. 1 whole day. So you can have all this information within a day. And then, I haven't said that, you observe that each of these bar is either white or black. If it's belonging to the bulls, it's white, it's going up. If it's belonging to the bears, it's going down. All right? If it's belonging to the bears, it's going down. If it's belonging to the bulls, it's going up. Okay? So please take note of that also. Take note of that also. All right? So, and then I'm now teaching you something else. I said that every bar, because there are many names for all these bars. As a matter of fact, if you open YouTube and all these things, you see a lot of people preaching candlesticks and all those things. I'm not a preacher of candlesticks because candlesticks can form at anywhere. I'm a preacher of levels. I want to see the price cheap and at an area of support, and then I can buy. All right. So the price level is more important than the candles. So there's a general thing that you just need to know about every candle. Is either the candle is a trend bar or a trading range bar. And I tell you how to use it to make trading decision. If a bar is white and it belongs to the bull, I know that if I see this kind of bar somewhere, I know that it belongs to the bulls, and I can take a trading decision based on that. I will teach you more right now. So just hold on. Now I now say, okay, how do we know that a bar is a trend bar or a trading range bar? I now said, okay, fine, guys. Let's say that the market was going up. It was going up like this, right? In the 5 minutes time frame, I see that we have an uptrend. If I translate it to the daily time frame, you know what I'm going to see? When I translate it to the daily time frame, what I'm going to see is a bar that is like this. It's exactly what I'm going to see. An uptrend bar. I don't know if it makes sense to you. If it is going down, right? If it's going down, let's say we have a downtrend, right? Like this downtrend. You know what I'm going to see? I'm going to see a red bar. Okay? I'm going to see a red bar. Right? I'm going to see a red bar. Let me take red. So what you see is from here, you see a red bar going down. You see a red bar from this high. So let's assume that, see what I'm trying to explain to you so that you understand it. And then you know what I mean when I say, who does this bar belong to? So this is, let's say this is 5 minutes time frame. When you open 5 minutes, you're going to have several candles, right? Many candles that forms this trend on 5 minutes. Now, all these candles, when you change from 5 minutes to daily, all these candles will just be one bar. And then when you look at it, you see that since it's an uptrend, it belongs to the bulls. If it's a downtrend, it belongs to the bears. Take note of this, very important, please. All right. Now, what if we have a trading range where the market is choppy? It's not going up, it's not going down. Market it moves up, comes down, moves up, comes down, moves up, comes down. Not going up, not going down, right? What do you have? What you have is very simply a trading range bar. That's what you have. This is what it's going to look like. So there are only two types of bars. You can, of course, this makes sense. And then what is this thing saying? This means that I call this an indecision bar because when I give you my strategy, I will make reference to indecision bar. This is an indecision bar. What this thing is saying is the market is struggling. Buyers are buying, sellers are selling. Okay, going up, going down, going up, going down, going up, going down. Nobody won. This kind of market does not belong to anybody. Market went up, went down, went up, went down, went up, went down. Nobody won. We cannot say, okay, this market belongs to so person. But clearly, clearly you can see that this one over here, right? This one over here belongs to the bulls. This one belongs to the bears. So understand that when you see a candle, generally, if it's a full-fleshed candle with lots of body in comparison to the wick, that when I say wick, rope, right? In comparison to the rope, you have a lot of body. You know that it belongs to somebody. If you have designed that your chart, you have black and white, you know that all the black bars are for the bears and all the green bars are for the bulls. And then when you have tiny bars like this, you know when you compare the wick to the body, you see that the body is small. You know that they were struggling. Buyers and sellers were struggling. Is that okay? And then what I tell you is this. If we have an indecision bar followed by a trend bar, what we now accept or say is that these people have eventually won. I'll tell you what I mean now. Clear all of this. You have to be in the habit of taking screenshots because you take screenshots or you make notes, right? And then I can assure you that most of the things I'm teaching you here, you are not going to find them anywhere. Yeah, because some of these things were things that I discovered myself, and then some of them I learned, and then so, right? So yeah. Okay, so really, you're not going to see most of these things anywhere. Okay. But I mean, as long as you stay with me, I will give you everything that I have. I do not hold back information. All right, I don't hold back knowledge. Okay, you're not a leader until you have proteges, until you have people who can do what you have done. Elijah, Elisha scenario, right? You're not a leader until you have an Elisha. Okay, so I'm teaching you good so that tomorrow I can, when I'm not in the market anymore, maybe for whatever reason, which I do not know, right? Yes. When I'm not able to trade, I know that I have people who can teach the way I teach and, make money also, right? Yeah. So just stay with me. I'll teach you everything. All right. So what we now say is I will teach you something really good and really quickly. See what we now say. We now say that, okay, yes, if there are two types of bars, we have a trend bar and a trading range bar. Okay, we have a trading range bar and a trend bar, right? Full-fledged bar, right? Full-fledged bar, and then a trading range bar, right? If we have these two kinds of bar, we are saying that the market was struggling, and then after this struggle, somebody won. Do you understand? So what we now say is the whole of this place here represents the trading range bar, and then this place now from here to here. Let me use another color so that you can see the difference there, right? This place here now, from this place, right? Traders now say, okay, from here to here to here, we have this. And then from this place, we have a trend bar. A trend bar that shows us early enough that the bulls have won. If I have a case like this, market has a trading range, breaks out to the downside, pulls back and starts to trade. Now, once the market comes out of this trading range, traders are already feeling like, okay, this market has broken out and has retested and is about to go down. So we can spot this by looking at, if this is happening on the 5 minutes, if you go to your maybe H4, for example, what you're going to see here, around here now, the whole of this place, what you're going to see is just one bar that looks like this. You will just see one bar that looks like this, right? And then from here, where the breakout happened, from here, where this breakout happened here, right? What you're going to also see beside the indecision bar, what you're going to see beside the indecision bar is a black bar that shows that it was the sellers that won after this fight. So they were fighting up, down, up, down, up, down, up, down until one of the two, bulls and bears, struggled until one of the two won. And then now, once they break out like this, we expect the market to start going down. So what I'm trying to teach you here now is that we can use this indecision bar and trading range bar as a basis for entering a trade. So traders can say, oh yes, market gets to this point. Look at what I'm trying to say. Traders can say, okay, market gets to this point, it touches this second point. All right, let me adjust that line. All right, so traders can say, okay, market was on this area, bounced here the second time. And then now market has come back and has bounced here. So traders say, okay, this was the first touch. And then this is the second touch. Now traders are waiting for the third touch. And then what they do is they say, okay, we want to see an indecision candle, guys. And then we want to see who won. I don't know if it makes sense. They want to see an indecision candle. And then they want to see, followed, after seeing an indecision candle, they want to see who won. And then whoever won, I can't change that. I don't know if you're seeing my screen clearly, but let me use something else to represent. Okay, so you have this example over and over and over and over. All right, so let me show you real quick using something else. So I will just wipe out all of this. Now, look at what I'm trying to see. See, guys. See what I'm seeing. This is a trend line. Trend line. In the subsequent class, because after this, I am going to be teaching you. I told you that the classes are free from now to the end of the year. So I'm going to teach you how to correctly draw a trend line. Okay, because you have to know which bottom is valid for you to place your trend line. All right, to wait for a third touch. Okay, so now if you're seeing what I'm doing, right? You see that this was the first touch here. This was the second touch. And then here we have the third touch. All right, so once the market touches for the third time, traders are waiting patiently to see if there is going to be an indecision bar. Look at this. This is an indecision bar. And then after the indecision bar, this bar here is as good as this is a daily, this is hourly time frame. I'm on H1. If I go to maybe M5 or M1, if you zoom into this particular candle, what you're going to see is a trading range, something that is like this, right? And then what happened after that bar? The next one was an uptrend that was showing that there's a breakout. So these two bars happening here have told you that the uptrend is about to start. There's a breakout to the upside. And then what do traders do? They will put a pending order to buy. Traders will put a pending order to buy. And then traders will put a stop loss here. You wipe out all of this. Traders are going to put a stop loss. They say, okay, trading range bar on a trend line, trading range bar on a trend line, right? Followed by a bullish candle showing that it is the bulls that won. Yes. What traders are going to do is they will place a buy order to buy one tick above this. So they put a horizontal line here that will show them the price. And then they put another line below the base of this candle that will show them the price. And then they will put a target. If this is, let's say, 10 pips, I'm going to take you now over to my slide where I would complete all the terminologies so that you understand what pips is and all the rest of that. If this is 10 pips, they will now say, okay, let's take, if from here to here is 10 pips, we're going to take 20 pips to the upside. And I want you to observe something. The way the market is printed, the market makes an indecision bar and a trading range bar worth 10 pips, it will usually reverse at an area of 1:2. Okay, so you see that if this is, yeah, sure, I believe so. If this is 10 pips from here to here, you can see that if you entered somewhere around here, you will be able to achieve 2 times. So you're going to place your target here, right? So you're going to call your broker via your MT4 using a pending order. You say buy stop, entry price here, entry. Use your horizontal line so that you get the price, the actual price. Stop loss here, and then target here, right? Before you come back from work, the market would have risen from here to this point, and then you would have had 400 naira added to your account. If you were wrong, you will lose 200 naira. I don't know if it makes sense to you. That's how to trade, guys. That's how to trade. So you see that the market is going in an uptrend. Market is going in an uptrend, right? Traders are waiting for a discount. And then when they wait for a discount, they look to see a confirmation. That confirmation is something like an indecision bar followed by a trading range bar. Stop below, entry above, 200 factored into these candles. And then target twice the height of these candles. And then you make a lot of money. Okay, you can make a lot of money from these things. All right, so yeah, having said all of this, before I show you my trading strategy, okay? Yes, it is, yes. Right, before I show you my trading strategy, I want to introduce you to some of the terminologies that's going to help us to predefine our risk. So I now take you to the calculator where you can now, we will set a hypothetical entry, stop loss, and target just for the sake of taking a trade so that you know how to tell your calculator that what I want to risk is just 2%, which is 200 naira. Is that okay? So I'm going to stop this and share. I'm going to share my slide. Okay. All right, please somebody look at the time, because if you leave me here, I will stay with you all day. All right, a minute. Yes. We're going to do practicals, but immediately after I introduce you to the terminologies, once I introduce you to the terminologies, we go straight to the practicals so that we don't have to come back to what is Forex or whatever is, right? So just hold on real quick. I will be very quick with this. I'm not a theory person. I don't talk too much. I just go straight to the market and I show you. You can see I'm already in the market and I'm showing you things already. So just hold on. We have to do this just to be familiar with some of the terms. All right. So like I said, I am not a theory person. I might not do too well with most of these things. But as long as I know that most of these informations are things that you can very easily find online, all right, I will not take time to talk about them. All right, so if you need more information on some of these things, which you might not need, right, you can go online and find those information. All right, so yes, first and foremost is that I've seen somebody who say, sir, I heard that you are an expert in forest. And I say, please, I am not an expert in forest. I am an expert in Forex, especially on WhatsApp. When they chat me up, they say, I heard you're a forest trader. Please, I am not a forest trader. I am a Forex trader. Okay, so yeah, it takes care of that. FOR you find here comes from foreign, and then EX comes from exchange. So it's an abbreviation. All right, it's an abbreviation. Please, can you hear me? Somebody is still saying he cannot hear me. Let me be sure if you can hear me, please. Let me be sure that you can hear me. Yes, good. All right, so I'll continue. Now, okay, so what we do is, unlike shares, in shares, yeah, and then I told you that Forex is the largest in the world. Forex is like about $6.6 trillion. So it's the largest, and that's how we can make money very fast. You can see when I was in that chart, you see how it was moving up, down, very, very fast. Very, very, very fast. So it tells you that you can actually make money very fast and lose money very fast also, right? So yeah, and then yeah, it's the largest in the world. And then Forex, if unlike shares, if you want to buy shares, maybe you want to buy Apple share, APPL, right? Or you want to buy Facebook, or you want to buy Amazon, right? You are buying only one thing. So you use your currency, whatever currency you have, to buy it. All right. But when you're dealing with currencies, there are two things, right? Euro, USD. It's not like you're buying euro or you are buying USD, right? You got to compare, or you have to put in two things together. So that's the way we trade it. You're trading one thing against another. So you are saying, I want to trade this against this. Unlike when you buy shares or maybe index, right? You're trading one thing against the other. That's what you have to bear in mind. Okay, so you can use Naira, you can use CDs, you can use South African Rand, you can use anything at all to buy Apple. All right, but when you are doing for currencies, there are two things, right? So you can buy this against this or buy this against this, right? So if you open a chart and the market is going up and this chart is labeled Euro USD, it means that Euro is stronger than USD. If you open your chart and the chart is labeled Euro USD and you see the chart is going down like this, right? Going down, you know that, and then it's still Euro USD, you know that it's a downtrend, Euro USD, it means that dollar is stronger, okay? It means that USD is stronger, all right? And then here we see Euro is stronger, okay? So what traders do is they buy Euro, all right? They take a trade saying that Euro will buy. And then here they say dollar is strong, and then they sell Euro USD. So here you buy Euro USD. Here you sell Euro USD. All right. So we're taking the two at the same time. Take note of that. All right. I'm not going to waste time on most of this. You figure them out with time. All right. And then yeah, it's also important. Yeah, and that's what I have here, right? So you can have this. If I have a chart of Euro USD, it's just going to be a flip, right? Right. This one will be called maybe Euro USD, and then this one will be called USD Euro. So I'm going to teach you something in the following slide where we talk about the base and the quote currencies so that you understand how to read a quote. Okay, so I'm going to rush this slide so that I finish every theory today. Tomorrow we're not doing any theory. Forex, I told you, is the largest. When you trade Forex, you should be expecting around 20% return every month. It's very realizable. Okay. Yeah, Israel is saying, yeah, I know, right? Yeah, so this is a comparison of New York Stock Exchange to Forex trading. You can see this somewhere in Nigeria, I think Akwa Ibom State, right, where you have a waterfall, right? So you can see this water compared to this one. This is trading shares, stocks, and then this trading Forex. Can't compare both of them, all right? So when you are trading stocks, you expect around 10% return in a year, okay? Then when you're trading Forex, you should be expecting as much as 20% in a month, okay? So Forex is large. Commissions are small. Advantages of Forex trading. Commissions are small. It's like Zenith Bank. There was a time, if you don't have up to 100,000 Naira, you can't open a Zenith Bank account. Later, they made it 10,000. You need at least 10,000 Naira to open a Zenith Bank account. All right? And then today, what do you have, guys? What do you have? You see there are ads. Ads from Zenith Bank. 0 Naira. 0 Naira. Okay? So when the competition is fierce, brokers are forced to reduce their commissions. All right? So that's what happened to the local banks. Starting account, 0 Naira. You have an account. In fact, banks like GT Bank will tell you that just dial so code and you have an account number. You can come later to our office to submit your documents. Just have your account number first. Right? So you can see it. It's cheap because of the competition. All right? So the commissions vary among brokers, and then the cost of transactions is also cheaper because we have thousands of brokers across the world. Thousands, no exaggeration. There are lots of them. And a lot of them will come to the radio and tell you, open your brokerage account, you can trade with $100, just put $100 there, yes, and start trading. All right, you blow $100 if you put it there, unless you can reach maximum of 2% in a trade. If not, you will lose it. I'm not just talking, I'm telling you statistics, fact. It's not consistent that you take a $100 account and multiply it. It's not consistent. It's possible. You can do it once and it works for you. All right, but most of the time you're going to blow the account. All right, unless you're able to take 2%. And I'll tell you, that's what happened to me before the broker called me. I was trading a $100 account, but I made sure that I do not lose more than 2% on each trade. I don't lose more than 2%. In fact, as a matter of fact, when you see my losses, the maximum you see is 1.9. Because when I factor in the 2%, I'll still make sure that I, increase the pips so that if I go wrong, it will be 1.9 something. It doesn't get to, it will be $1.90 something cents. And then when my profit at the end of the month is around $15, around $20, which is 15 to 20% of my capital. So I did that for about 5 months before the broker called me. And then it was Zenith Bank, right? So, and then I started trading for Zenith Bank, right? Today I trade for about 3 banks, okay? And I have like all these managers who we trade for via City Forex, of course, right? So the managers, we trade for them, they have a lot of money, so we give them just a 5% return at the end of the month because we are risking lesser amounts of their capital. So we make lesser amounts as per profits, all right? So take note of what I've just said. Okay, yeah, so the spread is cheap, all those things are cheap. Forex market is open from Monday, not Monday actually, from Sunday evening. Right, so the market is usually open from Sunday evening, right? So you have the market from Sunday evening usually around let's say 10 p.m 10 or 11 p.m, all right, and then it closes. So this is when it opens. Then it will close on Friday night, same time, all right, same time on Friday night, all right, that's when it closes. So, and I'll tell you why when I discuss trading sessions, you see all the different trading sessions. So BTC, you can trade BTC 7 days a week. You can trade BTC 7 days a week. It doesn't close, but the Forex market can only trade 5 days a week. And I'll take 5 days a week so that I can rest, right? I mean, rest, analyze my charts, my previous trades, see how well I did, see where I didn't do well, and look for corrections to make. Look for opportunities in the coming week. All right, so 5 days a week, that's how long it takes to trade Forex. Every week, 5 days a week, Monday to Sunday to Friday. All right, so yeah, I'm going to teach you all of these. I don't like all these theories, but I have to go through them. Okay, so I will do that real quick so that we can call it a day. Okay, because time is fast spent. All right, so this is a downfall. What you have right here, where you take a trade on Forex, scalping is not a strategy. Scalping is a group of traders. Somebody's asking, is scalping a good strategy? Your strategy is what will lead you to buy or sell. All right, scalping are people that trade on low time frame. All right, low time frame, like 1 minute, 5 minutes. They open a trade. They open a trade today. I mean, not just today. They open a trade and they are watching it. They have enough screen time. Okay, so they open a trade, open, close, open, close, open, close. All right, and then they do this opening and closing manually. All right, while these are scalpers. Okay, so they're just looking to make few pips. Once the market just goes up, 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 they close it. All right, it's a very risky way to trade, and you run a risk of cherry picking. Cherry picking is picking plenty cherries from the ground. You surely pick bad ones. All right, and then you lose your money, and then you might lose a lot of money too. Okay, so traders, there's no fixed trade. This is an advantage. So you can make a lot of money. You can just increase your lot size by yourself and make a lot of money, which is what we are trading against, or what we have been preaching against so far. All right, we have been advocating for managing your risk, but you can choose any lot size you want and capitalize on what we call leverage. Even though you have $100, you can buy something worth $5 million. That's leverage, right? You can buy something worth $5 million. Okay. All right. So guys, over here, I was saying this is a downfall because traders are people that They have never had the freedom of doing anything, all their lives. They've never had the freedom of doing anything. Yeah, as children, your parents will control you, tell you, don't do this, don't do that, don't do this, don't do that. You go to school, your teachers, your lecturers, they control you. The moment you come to the market, there's nobody to control you to say, make sure you do not use 2%. So the freedom to trade anyhow you want is an advantage and also a disadvantage. All right. So this is the only time where traders are free to make decisions by themselves. And then you see a lot of them will burn their fingers. Right. So I'm going to give you details about all of this. And then you can start very small, very, very small. With $10, you can have a brokerage account and place trades. But I always tell you, go get capital. Right? Yeah, you cannot take a trade and then trade like a professional with $10, obviously. So when brokers do this, they're just trying to lure you into the market because they are very sure that you will lose your $10. So instead of putting $10 and trading with dollar, translate this dollar to cents so that you can have, instead of having $10, you have 1,000 cents. So you can take 20 cents per trade. All right. So if you have $10, FXTM have cent accounts. So you can put your $10 and change it to cents so that you trade with the cent account. All right. So don't trade with $10 because if you try to take a trade, now your lot, when you take your lot size does not know whether it's cents or it's dollar or it's naira. What it knows is units. Okay. So if you have 1,000 as your balance and you risk 20 out of it, it's taking 20 units. It doesn't know what currency it is. So if you change your $10 to cents, you have 1,000 units. All right. Somebody's asking if I can trade for someone. Well, of course I trade for people, but not individually. I do not trade for people individually. Okay, we trade for I am one of the traders for City Forex. Okay, so there's some money that is allocated to me to trade. That's how I trade. So and then I trade for the bank because they meet a certain volume of capital which I can trade separately. All right. So but every other investor that we have, we pull their cash together and then we allocate it to different traders. All right. So that's how we trade. So instead of having me trade for you directly, you can invest with City Forex and get your monthly return. That's as good as it gets, right? Yeah, with Forex trading, that's as good as it gets. Okay, and then I've told you if you need an individual trader to trade for you, there are traders who are very consistent on eToro. Okay, they trade shares and then they are just looking for few percentage return at the end of the year, right? So you go have them trade your money for you. Minimum investment with City Forex is 50,000 naira. Just keep your questions within the frame of what I am showing you so that I can finish my presentation. Okay, if you have questions like this to ask, you can bring them at the end of the class so that we do not interrupt the flow of the class. Okay, and then I'm rushing to exhaust this slide. All right, leverage, guys. Leverage is very important. You have those of you who have $10. The only reason why you can trade with $10 in the first place is because your broker is giving you a leverage of 1:500. 1:500. It means that your $10 have been translated to $5,000. That's why you can place trades. Okay, and there's still a limit to what you can buy. All right. So the problem with leverage is that if you have this amount and you're trying to buy something that is really, really expensive, like now you want to buy a barrel of crude oil. Barrel of crude oil is about $30, between $30 to $40. You have $10, but you can buy it. You can buy one barrel, okay, because of your leverage. So this is the amount that you now have. You can place a trade, buy 1 unit or 1 barrel of crude oil, okay. So that's what leverage does for you, okay. Yeah, and then you can open your trade and close your trade at any time. All right, these are some of the advantages of Forex trading, right? And go to the next slide. Okay, there are some of these things you can find them online, but then, the way I'm explaining to you might not be easy for you to get all this analogy on the internet. Okay, because I'm teaching you because I know you're Nigerians, you are my brothers and sisters, and I have to speak in languages that you will understand, especially for many of you that are just experiencing Forex trading for the first time. Okay, so yeah, market hierarchy. We have a hierarchy in the market. Okay, this hierarchy is something I've introduced to you before. I've told you can not go to CBN directly. You have to pass through, some like the broker. The broker will now buy. Somebody say he has $10 in the account. You can't buy $10 worth of anything from CBN. Okay, so you can buy from the broker, and then the broker buys in bulk from CBN. So I'm not going to take any time on this slide at all. Okay. So if you want more information on market hierarchy, you can go online and check that out. right? These are the times, trading times. Okay, trading times, right? I have done this to fit with an average Nigerian. All right, so this is the Nigerian version. If you go online, what you will see is still 8 a.m., but you will not be able to know your own conversion or your time. They might tell you Eastern time or Central African time or whatever, whatever. But I mean, this is a translation that fits us. Nigeria and London have the same time, right? Nigeria and London, 8 o'clock in Nigeria is 8 o'clock in London. When the banks open in Nigeria is the same time the banks open in London. So when we say London session, it's as good as saying Nigerian session. Now, but I'll tell you what, sometimes there's a 1 hour difference. I think every 4 years, there's a 1 hour difference or a 30 minutes difference. That's when you see that big clock in London. There's a big clock on a tower in London. It's very big clock that has Roman numerals. I don't know if you have seen this thing, right? That big gigantic clock. You see them you see it on the TV sometimes. Okay, in England, on the top of that house. See that when it works with weather, right? And then when it lags, it could lag with 1 hour. So when this lagging occurs, it affects the difference between Nigeria and London. And then it happens, I think, every 4 years or every 3 years. So they will announce it on the radio that everybody go and move your clock backwards by 1 hour. Right? Okay, somebody say every 6 months. Okay, somebody say every 6 months. Right? So they tell you, I hope you're correct about that information. Right? So every 6 months, right? They will announce on the radio. I had a friend in England, I think one time. Onyinye, she was the one that told me, okay, hold on, they just announced now. Let me quickly adjust my time. Right? So you change your clock. You go to wall clocks and drag the time backwards. Yes, +1 GMT. Somebody say +1 GMT. All right, so you got to take note of that. And then, having known that, it means that London session is almost the same with Nigerian session. So when the bank open London in the morning, in Nigeria also 8 a.m. in the morning, the market starts to move very fast. Asia, these Asian guys, they are about 10 hours. They are about 10 hours ahead of us. Right? Those in Australia, I mean. Sydney guys, Australia. You know, this man say, whether it's Australia, what's that his name again? Whether it's Australia or Australia, he said that all of them, as far as there's Leah in all of them, you know, what's this preacher that is always vibrating? Odumeje. Say to let come out, let me give you your visa to Australia. So those in Australia, their time frame is 10 hours ahead, right? 10 in Daboski. Is in Daboski, right? Australia. So those in Australia, if rapture comes, I believe they will see rapture before us. So I have some friends in Australia. I would tell them that they should inform us when God stops the world, so that they will tell us, so that we'll repent. Liquid metal. Right? So that they inform us, so that we will repent. Those of us that are 10 hours behind, we'll go to church and repent. Pastor, pray for us. We start our fasting and go to heaven. So they are 10 hours ahead of us. And because they are 10 hours ahead of us, on Sunday evening, that is, today is what, Monday? Okay. On Sunday evening, when it is around 10 p.m. or even 11 p.m., because they are 10 hours ahead, they are already seeing their 8 a.m. So once Australia people gets to 8 a.m. in the morning, even though we have not gotten to 8 a.m., the market starts to move. You see that the market closes, the bar will close on Friday. On Saturday, there's no bar. On Sunday, there's no bar. But on that Sunday, once the time gets to 10 p.m. or 11 p.m., depending on that GMT, the 1 hour difference, right? You now see that the market opens, right? And then it's almost flat because these people, their volume is not so much. So, but when Nigerian banks open, Europe, UK, Frankfurt, France, everybody opens, you now start seeing the market moving very fast. And then New York is about 6 hours behind. So because they are 6 hours behind, what I'm saying is, even though right now it's past 7:30 in Nigerian time, New York is still around, let's say, 2 o'clock in the afternoon. All right. And then why the market closes around 10 p.m. on Friday? Why the market closes around 10 p.m. on Friday is because New York is still open. So as we are now, our bank in Nigeria, in London, have all closed. And by right, because the banks have closed, the market is supposed to close. But because New York traders are still around 2 o'clock, the market will stay 2, 3, 4, 5. Around 5 p.m., because they have a 6 hours difference. So that 6 hours difference means that the market now will wait until New York closes around 5 p.m., which is 10 p.m. on our own time. Right? About 10 p.m. or 11 p.m. on our own time before it will close on that Friday. So if you call any of your banker friend by 9 p.m. on Friday, they are still in their banking hall. They are still working. Meanwhile, we have already closed. So this is something you have to take note of. Okay? It's something you have to take note of. All right, so what it means is that the market opens Sunday night and closes Friday night. All right? And then, just so you know, there is a very high volatility because when New York opens, London is already open. London starts in the morning around 8 o'clock, around 8 a.m. And then 8, 9, 10, 11, 12. If you call your friend in New York around 12 o'clock in the morning, they will be at 6 p.m. I mean 6 a.m. They will just be waking up. Around 1 o'clock, they will be at 7 a.m. And then around 2 o'clock, these guys will be at 8 a.m. So what it means is that around 2, 3, New York always opens. So when the banks in New York open, right? When the banks in New York opens, it will be around 2, 3 in London. That is Nigeria. So you see that this crossing, all right, this is the period where you have the total number of traders, or the highest, so to say, the highest participation, all right, of traders. So all Nigeria, London, Europe, New York, they're all trading. And when you see the market is racing. If it is what's that game? Temple Run, right? If it's Temple Run, this period is going to, New York session is going to be called the lady with the red hair, right? It's going to be the lady with the red hair. It runs, right? It runs so fast. It moves very, very fast. All right, so this is everything you need to know about trading section. I have details. I have a lot of details, but I'm going to show you these details when we now actually get into our trading course fully. So some of these things, I'm teaching them just peripherally. All right, and then unfortunately, I have been spending a long time on some of the information here. All right, so yeah, these are some of the things you also need to know. I have to close the class any moment from now. So I'll finish up the theories tomorrow. These are some of the things you need to know. These are all the currency pairs. We call these ones major currency pairs. Major currency pairs are pairs that have, what's it called? Major currency pairs, they usually have dollar in them, okay? And then apart from the fact that they have dollar in them, major currency pairs, usually, they have, they are the highest trading pairs, all right? So you cannot just say because they have dollar in them, we want to include them as a major pair. If I take Nigerian dollar against Nigerian naira, dollar against Nigerian naira is not a major currency pair, even though it has dollar in it. So what qualifies you to be on this list as a major currency pair is that you are heavily traded. Okay, and then the advantage of this is that the volatility is very high. So you don't see the market, dragging too much. You see the market moving very fast. Okay, when you are trading this major currency pair. And then the charges are low, all right, low cost. The spread is low. I'll teach you spread, right? Spread is low, very low actually. Okay, so I'll teach you all of that. These ones are called minor pairs. These ones are currency pairs that are of, and then another thing you need to know is that they comprise of all the strong economies, very, very strong economies. We're talking we're talking America, we're talking Switzerland, we're talking Europe, we're talking, we're talking Canada, we're talking Australia, we're talking New Zealand, right? We're talking Japan. So the strong economies. No, Nigeria is not a strong economy. Yes, please. Okay, and then there's something we use to represent this currency. There's a local name for all of them. Euro is usually called euro, right? Dollar, we call dollar box, or we call dollar greenback. Okay, and then JPY, we call JPY yen. Japanese yen, that's what it's called, Japanese yen. And then pounds, we call pounds sterling. All right, so you have sterling pounds. And then Canadian dollar is called loonie. Okay, Canadian dollar is called loonie. Swiss franc. Okay, we call CHF, Swiss franc, used by Switzerland. And then Australian dollar is called Aussie. And then we call New Zealand dollar, we call it Kiwi. So these are like the local names. All right, because I want you to be able to recognize them when you are trading with somebody and then they say loonie is rising. You know that they're talking about Canadian dollar. They say all these things again. I'm going to teach you in details when we start to talk about the trading course. So I want to encourage you guys to take the trading course. It's going to help you to give you a lot of details. All right. So, but again, you mustn't take the trading course. We have some of these trading courses in our resource group, and I've told you you can access that group with 5K. Apart from that, I'm going to be teaching you for free from now to the end of the year. All right. So all of that is free. All right. So just do your best to see how you can avail. If you cannot join us in January, you can join us in April. So you make your payment whenever you have the money to make the payment, and then you join the second batch from April to June. If you can't meet up with that, you can join July to August. Can't meet up with that, you can join September to December. All right, so you can take the trading course, live trading course, or usually once they finish working on the site, the trading course is going to be on the site. So you can just pay for it with your card, and then take the trading course. All of this, I have taught all of this and recorded them. So you can take that trading course, and then of course, you can take the trading course and then learn at your own pace. Okay, you can pay for it and learn at your own pace. Otherwise, if you want us to have a progressive class like this where you can interact with me, then you pay for the one that will run for 3 months. It will now look like you are taking a classroom course. All right, so it's almost the same thing. All right. So take note of that, guys. So after now, those of you who might be interested in taking the course, you can talk to the admin either on Telegram or wherever, make payment for it, and then let me see you in the classroom. All right, but in the meantime, we have a lot of free materials. You can take advantage of them, okay, so that you can sharpen your mind. Now, all the strong economies are crossed. So if you observe here, the only thing that is missing here is US dollar. So we call them minor pairs. All right, I'm going to teach you something really deep about these things. What I do usually, I'm telling you now, there's no secret. What I do is I take all the minor pairs and major pairs, I put them together, and I look for the trend. So I see which one is buying everybody, and I see which one is selling everybody. So I know, okay, the market, dollar is very strong. It's pushing everybody up. Or Japanese yen is very weak. Everybody is selling it. Everybody is selling it. It's extremely weak. Okay, so if that's the case, then I know that I'm going to find a strong uptrend when I combine dollar and Japanese yen. I'll give you details subsequently. All right. Okay. Someone's asking if I can send the PDF. Can I? I don't know if I have it as a PDF, but you can find it online. Just browse for currency pairs. All right. But while I'm sharing my screen, you can just screenshot it so that you can have the list if you want to keep the list. These ones are exotic pairs. Exotic pairs. Yeah, sure, so much. Exotic pairs are economies that are just rising, like South Africa. Okay, I have a strong feeling that very soon we're going to include Ghana to this list. Ghana is doing very well. All right, so you can see that South Africa just gained independence when? South Africa just gained independence in 1990. And you have South Africa here. This is South African rand. ZAR. South African rand. It's a shame to this country. So I tell you what, anytime you see these people doing Sorosoke, NSAS protests and all of that, you know why you are fighting. Nigeria is terrible. You cannot trade. Open a US dollar Nigerian chart. You're going to see it choppy like this, choppy. Just see. You can't trade it. You can't trade it. And then you are seeing all this choppiness because CBN is pegging it. They are pegging the price at 4 something. The real value of Nigerian naira is worth less than the current amount. CBN pegs it so that our foreign investors will not run away. That's why I keep on telling you, don't save your money in naira. The day they will remove the pegging, it will fall and collapse to pieces. Open any chart on Switzerland. Their economy was their currency was pegged for a long time. Take the charts to daily. You see a big bar that dropped. That was the day they removed the peg, and it fell to pieces. It fell to pieces. So the day they will remove Nigerians pegging, CBN is paying heavily to maintain our exchange rate at 480. If they remove it, it will fall. And when it falls, you're going to be seeing that $1 is worth about maybe 500,000. All right, guys. I'm exaggerating. 500,000 is a lot. But it could fall to, let's say, 1.5. All right. And then you see that $1 is 1,500 naira. All right. So keep your money as dollar. Don't keep it as naira. I know what I'm saying. All right. So I think we're going to have to stop here so that tomorrow I'm going to start by teaching you how to read the quotes, because when I do this, I'll take you to the chart. So, but again, I'm moving at your pace and I'm trying to be detailed because I know, right? 500K. Yeah, so but yeah, I am trying to take my time to make sure that you can extract as much as you can from my presentation. Okay, so it's better that we take our time to explain something in details than to race through everything and then you are empty. Okay, so I'm going to finish up. I have just very few slides from this point. So once I show you all of these bid and ask, I can share these slides in 10 minutes. All of this, right? In about 10 minutes. Then we can now, yeah, then this is the last part, right? You can see I'm almost done with my slide. We can now go to the point where we predefine our risk. So we place a trade. All right. So we place a trade with your phone. I would open a trade here. I will show you how to open a trade here. So I'm going to open a trade here, and I'm also going to try to do it with my phone so that you're going to see what I am doing. So there are two things. It's either we connect our phone to the screen, or I'm going to share two links so that the first link, we're going to open it with the computer. I'm going to open the first link with the computer, and then the second link, I'm going to open the second link. I'm going to open the second link with the phone so that you can see what I'm doing on the phone, right? Those of you who are using your mobile phone, you see how I am, pressing everything. All right, Solomon, thank you so much. Thank you. Yeah, so please let me know if you have any question. If you have any question, let your question be based on what we have done so that we can close very early. So I'm going to go to the place where I unmute you. So if you have a question, you can ask, and then we can call it a day. Okay. Yeah. I just allowed you to mute yourself. So feel free to unmute yourself, ask your question, and then mute yourself once you are done. Okay, Messi, thank you. I'm seeing the big bet. Oh, I scrolled up. Okay. All right. Yeah, that's right. Well, with time, somebody's asking, um, say, what do you consider the most effective strategy? Most indicators give confirmation after price has completed a move or halfway through the move. Yes, I'm going to teach you a lot of strategies. And I'm going to tell you, I don't use indicators to trade because what we are buying or selling is the actual price itself, right? The only thing I want to see is maybe a bar or two that shows that, oh, the bulls are back. After they fought, now they are back. The market is going to buy, right? So since we trade based on price, I focus on price. Because before the indicator will start to print uptrend or show you that the market is going up, you will see that usually the market has gone very far. Because once the market goes far before the indicator starts to go up and show you MACD gets positive, all this, and then you have missed a lot of the trade, right? You have missed a bulk. So yeah, I'll give you better strategies. But in the meantime, we're going to take an objective indicator trend following strategy that we can use to practice. Okay, practice the whole buying and selling thing. Is that okay? And then after some time, those of you who are going to be with us, stay with us. I will teach you better strategies, better ways of buying and selling and making money. Okay. Sorry about that. Sorry about that. Okay. I if we're having a class tomorrow morning or evening, we're having a class tomorrow evening by 5. As a matter of fact, I already scheduled my flight back to Lagos for 5 p.m. I mean, the flight is by 6 p.m. So I just spoke with the coordinator today, and then I realized that I was supposed to have one more day, which is tomorrow, right? So I had to call the agents to cancel the flight and reschedule it for Wednesday morning. Okay, so we're going to have the class again tomorrow by 5. All right. So yeah, right now, yeah, I'm in Port Harcourt. It's my house in Port Harcourt. So I'll be going back to Lagos tomorrow. No, no, next tomorrow. Yes. Okay, Messi, I'm just seeing your message. I will attend to it. You're a very funny person. I'm going to attend to it, no problem. I don't know where you are, but my dear, it's not my fault. My madam is in Port Harcourt. That's why I have to always come back to Port Harcourt. Yes, please. If there is no other important question, let's allow people to go and sleep. Yeah, let's allow people to go and sleep. All right, guys. So thank you so much for your time today. I shall be with you tomorrow, same time. And then please be punctual so that we can do the important things. Tomorrow, our target is yes, you will get the recording, Elizabeth. You will get the recording. Our target tomorrow is to place a trade, to predefine our risk, to finish up my slide, and what else? Yeah, to get a simple strategy that you can use to buy and sell. So we're going to finish all of that tomorrow within 2.5 hours. Okay. So yes, God bless you and your family too. Thank you so much. All right. So in the absence of any question, I will have to end the class now. Thank you so much, guys, for your time, for your active participation. I love it. Thank you. You are the best. Cheers, guys.